You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today, before I begin, I want to remind you there is a website associated with this podcast called wealthformula.com. If you're interested in some of the additional resources we have there, or joining any of our groups, or getting some of those downloads, then go to wealthformula.com. And there's an opportunity also to join our accredited investor club and potentially participate in upcoming deal flow. Speaking of sort of the economy and all that stuff, a lot of you have asked me to give my opinion on, where the economy is headed, what to do specifically. And, I've been reluctant to do so because I'm not an economist. I don't want to give investment advice specifically. However, I do think I owe it to you to let you know where my head is and what I am doing based on these thoughts. And again, this is not investment advice, but this, I think, applies to just about everything that you might be involved with right now, okay? So let's look at last week's podcast. In last week's podcast and this week's podcast, which you are going to hear here momentarily, both of them, especially last week's podcast, have convinced me that rates really are going to fall and that they're going to fall significantly over the next 6 months or so. Why is that? Because I think that inflation, as measured by CPI, or any other measure that is standardly used by the Federal Reserve, is going to fall off a cliff. I really believe that, and I think the Fed knows that too, because they're not dumb. They know that. I don't even consider this a prediction, frankly. I think it's already written in stone, and here's why. Because, again, if you listen to last week, you heard Campbell Harvey talk about 70% of CPI is based on rent increases. That 3.1 number that was listed just last week, or I guess by the time you get this 2 weeks ago, and the variables used to calculate that number, that CPI number, is 6 months behind, right? And here's the thing. 70% of it is based on rent increases. It's 6 months behind. And guess what that number that was used for rent increases was? They used 6%. Now, anyone in the multifamily space will tell you that's wrong. Rents are flat. We see it every day. And all of the data available to us as real estate operators shows flat rent growth. If you look at any of the publications, right? I mean, I think maybe you go online, maybe you might see something that shows like a 3%. I think that's very generous. And knowing all this, all you need to do is ask yourself what this lagging indicator will show 6 months from now, right? Whatever happens between now and then actually doesn't even really matter, because the lagging indicator by definition will reflect what reality is today. And if the rents are where I believe they truly are, which is near flat, CPI will be below 2 in 6 months. Now, a CPI below 2, along with a slowing economy, which, I think we're seeing some suggestion of that right now, is probably going to result in a swift response from the Federal Reserve to cut rates. Because what do they fear more than anything else? They don't fear inflation the most. They have always feared deflation the most. It is the biggest fear the Fed has. So if they see inflation fall that precipitously, that quickly, make no mistake, rates are getting cut. And if I'm right, so I want somebody to email me in 6 months and tell me I'm wrong, because I will be surprised, right? But if I'm right, rates will come down, and anyone making big decisions today based on the assumption that rates are not going to come down, or that they're just going to stay stable for good, I think you're going to make a mistake. In other words, my opinion is to make sure that you're not selling from a position of weakness, which is right now. Do what you can to hold on what you own. That's what I personally believe. No, obviously not investment advice. That's what I'm thinking in my head, okay? And this week's interview with Richard Duncan really furthered my convictions of the inevitability of falling rates. It also painted a picture of China, which he's been talking quite a lot about lately, that looked a lot more like Japan in the 1990s. Anyway, the world, the economy, everything's changing very quickly. It always does, but sometimes it moves a little bit quicker, and there are seismic moves that kind of dictate for the next several years, and I think we're in the middle of one. Hard to keep up with, but make sure you listen to this interview with Richard Duncan after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast, he's been on the show multiple times. His name's Richard Duncan. He is an economist. He's the author of multiple books, including The Dollar Crisis, Causes, Consequences, and Cures, which was forecasting the global economic crisis in 2008 with extraordinary accuracy. And another book, the most recent one, The Money Revolution, How to Finance the Next American Century. He is also the editor of a long-standing publication called Macro Watch, which you can subscribe to. It's a video newsletter, and it is a very useful macroeconomic tool for those of us who are interested in knowing what's going on in this world with the economy. So, Richard, welcome back.
Buck, it's very nice to be back.
So
nice to see you.
You're in Asia, I assume, because we're talking late my time. So I'm assuming that
I am. Yes, I'm in Bangkok today.
Okay, great. Well, it's always interesting to have you on and get your perspective periodically. And right now I'd like to kind of start with this, sort of a catch up. I think we probably, we tend to talk like every 6 months or so here, and we seem to have this situation where inflation was starting to cool here in the U.S., and the Fed was looking at that and forecasting maybe some rate cuts, but all that seems to have been put on hold all of a sudden. And I'm curious what your take is on what's going on and what the realities out there are.
Yes, I think we spoke about, the last time was about 10 months ago.
Yeah.
And at that time, it did look like inflation was cooling. In fact, it was cooling. And everyone was quite optimistic that there would be rate cuts this year. Most people also expected, even at that time, they'd been expecting a recession that hadn't materialized. It still hasn't materialized.
Right.
So the most incredible thing since we spoke is just how strong the U.S. economy has been, and how everyone's been surprised by that. Inflation did come down. The CPI peaked at something like 9% in the middle of 2022. Now it's down to, well, it got as low as 3.1%. Now I think it's back up to 3.5% on the CPI. So it did come down, but the most recent months have been stronger than expected. And this is causing people to roll back their expectations about when the Fed will begin cutting the federal funds rate. At the beginning of this year, most people were forecasting 6 rate cuts this year. The Fed had told the world they would cut rates 3 times, but even now, 3 times is beginning to look questionable. There may be fewer rate cuts than that, and perhaps none at all. We're about to get the CPI numbers. We're about to get the GDP numbers this week, and also the Fed's favorite measure of inflation, which is the PCE price index, Personal Consumption Expenditure Price Index, and that's lower than the CPI, and it's actually getting quite close to the Fed's 2% target. So that's going to be a very important number. I think it comes out on Friday, the 26th of April. And if it's good, then everyone is going to be very pleased with that, and the markets are likely to go higher. But if it turns out to be bad, and particularly if it's substantially worse, then that could deal quite a big blow to the stock market, to expectations about rate cuts. And then the other big thing that we have on the horizon now is the companies are about to begin reporting their results. And it's going to be especially important what the Magnificent Seven report over the coming couple of weeks. Everybody in that group except NVIDIA will be reporting quite soon. And hopefully their earnings will be good, because their shares have certainly performed extremely well in most cases since we spoke last.
It's interesting. I had a fellow on the show last week. I don't know if you know him, Campbell Harvey. He is a economist at Duke. He was the first one to, I guess, really sort of coined the inverted rate or inverted yield curve concept as part of his. And he's a smart guy, and he was pointing out something interesting. I'm not sure if this is something that you have dug down to. Is that his CPI? He looked at the CPI and looked specifically at the indicators of rent increases, and pointed out that the variables that the Fed uses in that CPI for rent increases is generally a lagging indicator, and that they were using a 6% rate increase for that CPI number. But if you look at real-time numbers, it's pretty much flat. And at generously, maybe it's 3%. But based on that and the fact that he said that it was about 70% of the CPI was based on that number, he was very much, he was very much in the school of, I think he corrected for that, and the CPI came out to about 2.1, which would be right about where the Fed would be comfortable with. I'm curious, do these other indicators all use those kind of lagging? Because such a big part of the CPI is the rents, and me being specifically in this multifamily space, not only are we seeing this big statistics on these numbers, but we're also seeing it in real time. I mean, we are a value add group that is maybe getting 2% rent increases when, during COVID, we were getting 11%, so it's a huge difference.
Right.
Yeah.
Right. So the Fed's favorite measure of inflation is the Personal Consumption Price Index, the PCE price index. And there's also a core PCE price index. Now, the core strips out food and energy because they tend to be more volatile, but they keep an eye on that as well because it does suggest what may be happening in the future on the other price index. But in their favorite measure of inflation, there are three main components. One is, as you mentioned, rents, and the other is core goods prices, like just goods. The other is services, excluding commodities, and stripping out the commodities and the food and energy. So there are three main components of that. Those three: goods, services, excluding commodities, related services, and housing. So the goods have actually been deflating. 5 out of the last 7 months, goods prices have actually fallen month on month. So we've got deflation on the goods side. And in terms of the services, that is driven largely by wages to a significant extent. And wages are quite strong, but they have been coming down pretty steadily. The most recent month, I believe, the wage was 4.5% year-on-year wage growth. It seems to be trending lower. The labor market does seem to be suggesting that it's getting a little looser, despite these extremely good job numbers that we keep getting month after month. And then the final one is housing. And as you said exactly, housing is lagging. And almost everyone who knows anything about this is saying that this is going to fall just because of the way it's calculated. We know rents are much lower than they used to be, but as it's calculated in this particular index, it doesn't reflect the current level of rents, but what they were 6 or 9 months ago. So that's almost certain to fall. So it does seem like the inflation rate will continue moving lower, but everyone was surprised by the last couple of months on the CPI, which were strong on a month-on-month increase basis.
The one that's coming out, the new inflation index, what is that? The next one that you were talking about,
That's
not CPI?
PCE.
PCE. Okay.
PCE. It's a personal consumption expenditure
got it.
price
And
index.
is that also used that same lagging number for rents, or is that different?
Yes, that uses a lagging number for rents as well.
Seems very challenging to look at the economy like that, though. I mean, if you put that into perspective, 6 months from now, knowing what we know with what real-time, with real-time rents are, you can almost guarantee that number is going to be low, like it's going to fall off a cliff.
Right. I don't know how it came about that it's calculated like this.
Yeah.
This is something that people have only been talking about over the last, 6 to 9 months when they could see where this was heading.
Yeah.
And everyone is so interested in the inflation number now that everyone's laser focused on all of this detail. So I don't know how it came about that they use this lagging indicator for rents.
So what does the Fed do now? I mean, you said obviously they're probably going to hold off on cutting rates because this is the data they have. They have to use whatever data they typically use, I guess, whether that's real time or not. Do you think that they, I guess, become aggressively hawkish at this point?
No, I mean, the Fed it is data dependent. They always say we're going to be guided by the incoming data. So they're kind of in a bind. They can't really cut interest rates very aggressively if the inflation's still coming in significantly above their 2% target. But at the same time, they also try to look into the future and see where things are going or likely to go in the future. And I do believe that they think the economy is going to slow down and weaken significantly going forward. Now, people have been expecting this for quite a long time, but there are some good reasons for believing that. One is that credit growth is slowing very substantially.
Yeah, that's a big one for you.
I believe
obviously.
Credit growth is one of the main drivers of economic growth. And last year it was weak. It grew by $1 trillion less last year. Total credit grew by $4.1 trillion in 2023. That was down from 5.1 the year before. So $1 trillion less. And looking into and all the major sectors of the economy, except the government, had much slower credit growth. And with interest rates this high, that's likely to continue to weaken. Credit growth is likely to continue to weaken. Households are likely to borrow less because they borrow on their mortgages or on their credit cards. They have to pay very high rates on those. Corporations are likely to borrow less. The government-sponsored enterprises are borrowing less. Non-corporate businesses are borrowing less. They're all borrowing less because of the high interest rates. And the longer this continues, the weaker credit growth becomes, the more that sooner or later that's going to catch up with the economy and perhaps suddenly tip it into a recession,
Right.
Although there's no sign of that yet. But I think the Fed believes that's going to happen. And I believe the Fed would like to start cutting interest rates to try to get ahead of the curve. They can see this is coming. They don't want the U.S. to go into recession. They'd like to have this nice, perfect, soft landing that they've all been dreaming about. And to make that happen, they're going to have to start cutting the federal funds rate probably sometime this year, even if the core CPI or the CPI is still above their 2% target. So they're going to have to do some fancy talking to get away with that if they're going to cut interest rates with the inflation rate still above 2%. But they might do that because they probably should do that. I mean, their favorite measure of inflation now is 2.5% last month. So that's not really very far from 2%.
No.
It's not really worth taking the chance of tipping the economy into a recession just for that difference, 2.5 rather than 2. So I do think that they're not going to be extremely hawkish. I don't think they're going to start saying we're going to start hiking interest rates unless we do get a big round of higher than expected inflation numbers.
Yeah.
If that persists, then they would. But I don't think that will persist. So I don't think they're going to turn very hawkish. And in fact, they're going to start being a little more dovish on one front very soon, and that's on quantitative tightening. Quantitative tightening is the opposite from quantitative easing. With quantitative easing, the Fed is effectively creating money and pumping it into the economy. Quantitative tightening is the opposite of that. They're taking money out of the economy and destroying it. And they're destroying $95 billion a month of money. And that adds up. That's $1.1 trillion a year. So they've already destroyed more than $1.5 trillion since they started doing this. Their total assets went from about $9 trillion to less than $7.5 trillion now. So they've destroyed a significant amount of money already. And they're worried that if they destroy too much, there won't be enough liquidity in the banking system, and somehow this will cause the financial markets, or particularly the the market for federal funds, to freeze up, and the overnight interest rates to spike up the way they did in September 2019. And so they want to leave enough liquidity in the system so that doesn't happen again. So they've already told us in their most recent Fed minutes that they intend to start winding down quantitative tightening. Right now, they're destroying about $95 billion a month, but at the next Fed meeting, the next FOMC meeting, they may perhaps tell us that they are planning to reduce that by about half, say down to 45 or 50 billion a month. And that would be dovish, because the more money there is in the financial system, the better it is for liquidity, the better it is for stock prices, etc. And so by removing less money, that's a very positive thing, which would be viewed as a dovish thing. And that would be supportive for asset prices. And that seems that's on the board. That's going to happen pretty soon, unless we get some radically bad news to stop them from doing that, because they've already said in their minutes that that's going to start happening pretty soon.
Yeah. Let's switch gears. I know you've been talking, in your newsletter quite a bit about China.
Before we do switch gears, let's just spend a couple of minutes on talking about why the U.S. economy has been so strong.
Okay, yeah.
There are several really interesting things going on. Perhaps the most important one is we got this massive amount of stimulus. We've talked about that before during COVID. The government, the Fed created something like $5 trillion, and the government was probably $7 trillion of injections of stimulus money during that time. And this was an enormous amount of stimulus, almost like we were fighting a war. When the government fights the war, they have a tremendous amount of spending and stimulus, and that creates an economic boom. During World War II, the government spent so much money, it brought the Great Depression to an end. And then after World War, the government debt went up above 100% of GDP, but that government spending created an economic boom that lasted for 2 decades. So while the spending hasn't been quite on that level, we're probably seeing the echo boom from that COVID stimulus still going on. In other words, when they sent out stimulus checks, that people got those checks and they deposited them into their bank account. That resulted in total bank deposits belonging to people like you and me. Total bank deposits jumped by 35% over 2 years.
Yep.
Nothing like that had ever happened before. And those deposits are still in the economy. They're only slowly being removed by quantitative tightening. So that's one thing. Another thing that's related to that is we've had an explosion of wealth in the US. Over the last 4 years, since the end of 2019, the total wealth of the Americans has jumped by almost $40 trillion, $39 trillion. So that was up from like 110 from say 110, it's actually 156 now. So this was like a 40% jump in wealth in 4 years.
And what do we attribute that to?
$39 trillion of new wealth. Well, part of it was the interest rates were zero for a very long time. The other part of it was a lot of quantitative easing for a very long time. And then most recently, the AI boom. Everyone became extremely excited about the Magnificent Seven and created a new round of asset prices inflation there. So $39 trillion in 4 years, to put that into perspective, the entire US government debt is only $34 trillion. So there's been enough wealth created in 4 years to finance the entire US government debt. So this wealth creation that has occurred, people say it's just paper wealth or artificial wealth. Well, I can assure you, you can spend that money and buy yachts with it or whatever. If you're a tech billionaire, that's real money. And it's stimulating consumption and it's stimulating economic growth. And then we still have big budget deficits. The stimulus has really continued even after the COVID period is over. Last year, the budget deficit was I think $1.6 trillion. This year is going to be 1.5, and it's going to stay at that level for the next several years, according to the Congressional Budget Office. Now, part of this is related to the big economic bills that were passed by the previous Congress, the Infrastructure Act, the Chips and Science Act, and the Inflation Reduction Act. That money is now beginning to pour into the economy and resulting in a lot of spending occurring now. And that spending is going to continue to occur over the next many years on a very large scale. So that's creating growth. Then there is immigration on a very large scale. We know that people are coming across the borders in record numbers. I'm by no means an expert on this, but I did look into this last night. And one paper I was reading suggested that there have been 9 million people who have crossed the border over the last, say, 3.5 years. And that paper suggested that 70% of those people are allowed to stay in the country. So that's something like 6 million additional people in 3.5 years. That added about 2% to the US population. So with a 2% population boost to the country leads to more economic growth. Those people are earning money and spending money.
Yeah.
And that's stimulating the economy. Those are just, some of the big factors that are driving this very strong economy.
Interesting, because I wouldn't have thought that immigration was one of them, but just because of the, specifically, I guess at least during the Trump administration, very clamping down on legal immigration, at least from most of the world. But this is primarily what I think what you're referring to is like, undocumented immigration cross border. Yeah,
that's right. I mean, the strong job growth numbers that we're getting, I think last month was like 300,000 jobs were created. And a lot of those were probably immigrants who were looking for work. And people tell me that in the United States, they can't find enough people to hire. And that's what the newspapers are all reporting as well. So these immigrants are coming in, they're getting hired, and they're earning money. And I think most of them are paying Social Security taxes. And they're earning money and they're spending it, and it's stimulating the economy and making the economy grow.
It certainly seems like we have all the ingredients for a soft landing if somehow the Fed can navigate the rates and inflation in such a way that they don't, push it into a recession.
One final point on reasons for the boom is the energy boom that's occurring in the U.S. Last year, we had record oil production, almost 13 million barrels of oil produced a day on average last year, making the United States the largest producer of oil on the planet. Plus, we've got incredibly large amounts of natural gas on top of that, making us energy independent. So all of these things working together are really helping the economy. That explains why the economy has been as strong as it has been.
And on the other hand, there's China.
China, yes. So
let's switch to China. Let's talk a little bit about what's going on there.
Yeah, okay. So on my video newsletter, Macro Watch, recently I've made 3 videos on the economic crisis in China, which I think is the worst that they have experienced since the days of Chairman Mao. They've got a number of really serious problems that I think mean that they're just going to stop growing altogether. Let me discuss them briefly.
Yeah.
First, there is the property crisis, right? They have so much excess property that there are estimates, I've seen estimates that they have enough empty apartment buildings already to house 150 million people. And their entire population is 1.4 billion.
And shrinking.
So,
right.
And shrinking. So there's no reason for them to build one more apartment building, if you look at it like that, because they've got way too many apartments already. They have more apartments than they have people. And So this is an enormous problem for them because the property sector has accounted for about 25% of their economic activity. Now, all of the things that go into building a building, like steel and cement and tiles and carpets, and construction workers, and all of the other things you need for building millions of high-rise buildings, they don't need those things anymore. But those industries, steel, cement, all those industries, they employ millions and millions of workers. And so what are these, are they going to, the amount of steel that they have produced has increased, just multifold over the last 20 years. And the same with cement. There's a very interesting statistic about cement. Back in, sometime 10 years ago, the newspaper started running this story that in 3 years, 2011, 2012, and 2013, China produced as much cement in those 3 years as the United States did during the entire 20th century.
Wow.
Well, they've done the same thing every 3-year period since then.
Was majority of that for work done inside of China, or did they export a lot of it?
Well, most of it was for inside of China. Almost all of it was for inside of China. But when they, got to the point where they didn't need another, they didn't need the 6th bridge over this river, when they already had 5
right
in a small town, they got to the point where they became quite desperate, and that's where the bricks and road concept originated. They thought, okay, well, we've got all of this cement and all of this steel and no place to use it domestically. So let's start building highways all over the world,
mm-hmm.
and we will sell our cement to the Africans and all across Asia and even all across South America. And we will lend these countries the money to buy our cement. And that way we'll keep the cement factories and the steel factories going and all those people employed. Well, now they've got to the point where that worked for a while, but now the countries they lent money to, many of them are having problems even paying the interest on the money they borrowed from China. So these are just turning into more non-performing loans for the banking sector, on top of all of the massive non-performing loans the banks already have from lending to the property companies. So that worked for a while, but now where do we go from here? They don't need to build any more residential property buildings, but they're still building them. But what's the point? Pretty soon they're going to have twice as many units as they do people, and then 3 times as many units as they do people. This is clearly, this game is over. So that means 25% of their economy is facing a multi-decade recession. So that's the first big problem. Another problem is that their population is shrinking now. It's shrinking by about 1 million people a year. And the UN is forecasting that by the end of this century, that China's population will lose 600 million people. The population will shrink by 42% between now and the end of this century.
This is sort of the repercussions of the one-child laws that they had for decades, correct?
That's right. That's right. That has been in place for decades, and now they've gotten to the point where a lot of people in China just don't want to have children. They changed the law recently, but they're still not having children. When populations reach a certain level of wealth, they have far fewer children.
Mm-hmm.
When they move off the farms, they need the children to work on the farms. But when they move into the cities, they don't need children anymore, so they stop having them. They become a burden rather than an asset. And so people just don't want to have children anymore in China. The same thing's happening in many other countries around the world too. I think the worst case is in South Korea. So their population's shrinking. So that's a huge problem. The third huge problem is that the other part of their economic growth model is that China has always invested much more than it consumes. So it's been investment-led growth. If you look at investment as a percent of GDP in China, it's something like 44% of GDP. whereas in the United States and most other normal countries, it's half that level. It's something like 22% of GDP. So China invests far more than it consumes. The level of consumption to GDP in the United States is 70% of GDP in the US is consumption. But in China, it's more like 40% or even less than 40%. So they invest too much and produce too much and consume too little. And they take all of the surplus production and export it overseas, primarily to the US, but other countries as well. But the US has been the main buyer. The US trade deficit with China since 1990 has been something like $7 trillion. That the US has bought $7 trillion more of goods from China than China has bought from the US. So this has been their growth strategy. You could say it's driven by excessive investment, followed by exporting all of the surplus abroad. But now they've gotten to the point where their economy is just so big, the rest of the world is simply not willing to continue absorbing their exports. So you have growing backlash against trade with China. The US has already put up significant trade tariffs on China, and it looks like they're going to keep putting them higher. And now Europe is going to do the same thing. China is producing extremely cheap electric vehicles that came about in large part as a result of a lot of government subsidies to the vehicle makers. If these vehicles are allowed into Europe, then they're going to destroy the European automobile industry, which was one of Europe's most important. Mm-hmm. So, goodbye BMW, goodbye Mercedes-Benz, goodbye Fiat, and all the others, because there's just no way the Europeans can compete with the Chinese electric vehicles. So Europe's going to put up trade barriers. And it doesn't help China at all anywhere in the West that China has become best friends forever with Russia. The Europeans see Russia's invasion of Ukraine as an existential threat to Europe. They believe that if Russia wins in Ukraine, then Poland is next, and that it's going to be a return to the days of the Soviet Empire. So for China to make it clear that they are willing to help Russia in their war and invasion of Ukraine, this has made a lot of enemies for them all across Europe and in the United States as well.
You wonder why, though. Like they seem to be a very pragmatic society when it comes to economics, and that move I don't quite understand. What do you think's behind it? I mean, they've got to know that's a bad idea. I mean, for business.
It's hard to second guess them, but it seems to just have been a really bad mistake on the part of President Xi. And he didn't inherit an easy situation. China's had an economic bubble for a long time. It was going to inevitably bust, but his approach to that has been, let's just let it bust, let the property sector collapse, and the government will take over all of the private sector companies that used to exist privately. And his goal is to reassert the communism in China. Of course, China has always been controlled by the Chinese Communist Party. The Chinese Communist Party wasn't really especially communist until President Xi decided to make it more communist again.
That's why they've thrived as well, though, right? I mean, if they were just, communist in the way that the old Soviet Union was communist, they probably wouldn't be communist anymore.
Well, that's right. I mean, they thrived because they became more capitalist, but the party continued to be authoritarian and had complete control over the economy. They just let the private sector grow. But now Xi is reining in the private sector. He reined in the tech companies and several other industries. Now he's taking over the property sector, and he's a big fan of communism, it seems, and totalitarianism. And China and Russia have been off and on allies and communists together, going back to the beginning of the 1917. It's really hard to say. He has great aspirations for China regaining its place in the world as they view it. after being held down by the West for so long as they see it. And he would like to find a way to unseat the United States uh, in every way possible. So they've created this BRIC organization that they hope to gain some leverage that way, but it doesn't look very promising for them. And so Xi's reassertion of control over the economy back under the central government's control, that's another reason the economy is not likely to grow very rapidly. But the real problem is that their exports are just going to stop growing and are, in fact, they're likely to shrink because China's exports grew and grew for a very long time, from the mid 80s until about 2014. And then they dipped and flattened out for a few years. But then when COVID started, the Americans got a lot of stimulus money and they were locked in at home, and they all bought running machines and computers and telephones that were made in China. So suddenly China got a very big boost to its exports in 2021, 2022, 2023. But now that is over and China's exports are likely to drop. And when China always exports more than it imports. So when China's exports drop, its imports will drop. And when imports drop, that's going to be very bad for the rest of the world, because the rest of the world will no longer be selling as many things to China as they were before. So people doing business in China now are facing quite a difficult future. First of all, the economy is not going to grow anymore. And also, China's likely to import less than it did in the past, because if the economy is not growing, they don't need to import things from abroad. And then finally, with the West, Europe and the United States imposing, and Mexico and Brazil and India and other countries imposing trade tariffs to keep out Chinese dumping of Chinese goods, China is going to retaliate and punish the companies doing business in China. And so all of the people who have benefited most from China's great economic boom over the last 2 or 3 decades, the big winners of the past are likely to be the big losers looking ahead, because China's just not going to grow anymore. And it actually could go into quite a serious recession.
What do you think so there's obviously implications for the rest of the world with, China's been this dollar store for the world, right? And I guess part of it is a transition probably to potentially other countries too, like India, probably getting a bigger share of that kind of business. Do you see that as you go back and you look at what happened in Japan, right? In the 90s, and they were growing like gangbusters, and there was lots of exports. And then they, even though they are not communist, they did have this massively shrinking population. So it seems to me China's got a similar problem, and in addition to that, they're under a totalitarian communist situation. But I guess I'm just looking and thinking ahead. How does this end up? I mean, do you end up sort of transitioning to other countries that sort of take up the slack, that represent less risk, less threat to the U.S. and Europe?
So with Japan, Japan had an enormous economic bubble during the 1980s. It had boomed for decades on the back of export-led growth. But their bubble was primarily a price bubble in terms of property prices, and also in the stock market. In the late 1980s, I visited Japan, and they were really enjoying themselves. Most stock prices were trading on a 100-time PE multiple, and the gardens around the Imperial Palace in Tokyo were more valuable than California. Huh. So it was just an incredible price bubble in Japan. But they didn't have the kind of massive excess capacity of property units that China has. So China's problem is, in some sense, worse. The prices may not be as high as they were in Tokyo, but for instance, the average property unit in property prices relative to, it takes 48 years of annual income in Shanghai to buy an apartment in Shanghai. In Paris, it only takes 17 years, and in New York, it takes 11 years. So prices are very high in China as well. Plus, they've got this massive excess capacity. So they've got two problems, whereas Japan really only had the price problem. So looking ahead for what's going to happen to China, so when the Japan's bubble popped in 1990, they essentially haven't had any economic growth since then.
Right.
The GDP last year was the same size it was in 1993 in nominal terms. So no growth in 30 years. And the only thing that kept them from having a Great Depression was they had a massive increase in Japanese government debt. Every year they ran very, very large budget deficits. And so that stimulated the economy, and they kept the economy growing. And it gradually allowed the private sector to deleverage and reduce their level of debt and sort of return to a more normal level now. But government debt increased from 60% of GDP in 1990 to 260% now. So from 60% in 1990 to 260% now. That's more than twice as high as US government debt to GDP.
Mm-hmm.
And also it's more than twice as high as Chinese government debt to GDP. So in order for China to avoid a Great Depression, I think they're going to have to follow the Japan model and run very, very large Chinese government debt, budget deficits every year. And with that government spending and government borrowing, that should be enough to keep the economy flat rather than collapsing. But that's going to require Chinese government debt moving to a very much higher level than it is at the moment. Even the IMF is forecasting that government debt is going to increase. So total government debt, in China, there's central government debt, but there's something that they also call augmented government debt, which is a truer picture of the true level of debt in China. It's the central government debt plus the debt of the provincial government's financing vehicles, which are sort of off balance sheet financing vehicles that belong to the provinces, the states, you might say, the provinces, that the Chinese central government is ultimately going to be responsible for that. So when you add together all of the debt that the central government is actually responsible for, they're running budget deficits now that are about 13% of GDP. That's roughly twice the level of the US budget deficits now. And that's likely to continue far into the future. And in that way, that should keep China from having a depression, but they're probably going to end up like Japan with no growth. So the world should anticipate, no more growth from China, plus trade retaliation in response to the trade barriers that the rest of the world are going to put up against Chinese goods. So it's not looking good for China or for people who do business in China. But your other part of your question is, well, so what's going to happen in the rest of the world? Yes, well, other countries are already beginning to benefit from this.
Right.
Vietnam has been a major beneficiary so far, and they're just going gangbusters there. They're going to be hit to some extent by the slowdown in China, but on the other hand, they're going to be compensated by that because the U.S. and other corporations will be investing and producing more in Vietnam. India is really on a smaller scale. You could say they're just getting started in this export-led growth model that all of the other Asian countries have followed so successfully, starting with Japan, and then Taiwan and South Korea, and Thailand, Malaysia, and Indonesia, and later China, more recently Vietnam. Even Bangladesh is on the bandwagon. And now India is finally entering this period of export-led growth, but they're still at the beginning stages. It's going to take some time for them to build out their infrastructure and train up their workforce and attract the investment that they need to make this happen on a significant scale. It's going to be quite some time before India's growth compensates for the lack of growth in China in a meaningful way.
Although that transition with several other countries, as you mentioned, China doesn't have a whole lot to stand on. right? I mean, if you at least with Russia, they've got their natural resources and all that. What does China have if not for cheap goods that other countries can take over that task, right?
Well, one thing that they do have is a plan and a strong will to invest very aggressively in the industries and technologies of the future. And some of these things are likely to pay off and could pay off in a way that is game changing. I mean, for instance, China now invests more in research and development than the United States does. I think in the year 2000, it only invested 10% as much in R&D as the US does. Now it actually invests more in R&D than the US does, and they're making some major breakthroughs. For instance, China has hypersonic missiles and the United States does not. So despite all of China's economic woes, some of this money that was being funneled into building empty property buildings, an increasing amount of that money is going to be funneled into developing artificial intelligence, quantum computing, nanotechnology, and weapon systems, advanced weapon systems. And that makes China still a grave threat to US national security. So even though their economy is facing serious trouble, that doesn't mean that they're still not a danger to us. In fact, they are a very serious danger that we need to match in the United States by investing ourselves much more aggressively in industries and technologies of the future.
Yeah, and certainly, the presidential election's coming up, and certainly the Trump administration, if they are reelected, has always taken a very, very aggressive stance against China, probably for this reason, right? I mean, at the end of the day, understanding that this is that China does represent a significant threat, and trying to stave that off.
Well, it seems the only thing that the two parties do agree on in Washington these days is that China is a threat and needs to be curtailed. But while President Trump put up big trade tariffs on Chinese goods, there was no real movement toward investing in new industries and technologies during his administration. Whereas under the Biden administration, things changed dramatically. We got the Chips and Science Act, which is resulting in $60 billion being invested in building semiconductor manufacturing facilities across the United States. Plus the Inflation Reduction Act also is going to result in, they're saying, $1, $2, $3 trillion of new investment in new technologies over the coming decade. And so we're getting massive investment now, but even still, that's just not enough, because China's still investing more than we are. So the Chips and Science Act was great. Altogether, I think it was $380 billion, with $60 billion going to chips and the rest going to other industries and technologies. But the $380 billion over 5 years, that's just not enough. China's still going to outspend us. We need sort of a Chips and Science Act, every couple of years if we're going to keep pace with China. Regardless of which, I hope both parties understand that and act accordingly. We don't need government austerity in this sphere. We need aggressive government expansion and investment in new industries and technologies. Otherwise, we're in grave danger at the national security level, and it could be surprised by some new technology we have no way of responding to. In a Pearl Harbor catastrophic attack scenario.
Well, that's something to think about, and unfortunate kind of situation. What else do we need to know? But we should probably let you go here in a minute or two. I want to make sure you close off any thoughts that you have that you want to finish out.
So we've covered a lot. I mean, we've talked a lot about China. One of the Macro Watch videos was called China Turning Japanese. And I think that kind of summarizes it.
Right.
There probably won't have a Great Depression, but no more growth. And
Yeah.
people need to take that into consideration, anyone planning to do business in China. We've talked quite a bit about the U.S. economy as well, hit on all the major points there. Keep your fingers crossed for the next couple of inflation reports, because that could hit the stock market either in a good way or a bad way.
Right.
As will the upcoming results for the Magnificent Seven.
Tell us about Macro Watch.
So, yeah, thanks. Macro Watch is my video newsletter. Every couple of weeks, I produce a new video discussing something important happening in the global economy. As I mentioned, I've done 3 recently on China's economic crisis. Before that, I did a series on the Magnificent Seven. And I don't give specific investment advice on individual companies. But with this series of videos, I described how each of the Magnificent Seven, what it's doing to develop and deploy artificial intelligence. Because artificial intelligence, Macro Watch looks at the big picture, global macro. So I usually don't talk about individual companies, but artificial intelligence is going to have such a profound impact. It is a macroeconomic event that is going to change our macro economy. So it's important for people to understand that and to see who's doing what and how this is going to change the way we live and work going forward. So I did a series of videos on that. More normally, I do videos on things like credit growth, Fed policy, the policy of the other central banks around the world, and how the government's trying to manage the economy to ensure that it doesn't, in our new economic system, the government does everything in its power to make sure that the economy keeps growing. So it's important to understand that, whether you like it or not, you need to monitor government policy, because the government is having a very, very large impact on what happens to the economy at the macro level. So I follow those sorts of things. So yes, every couple of weeks I upload a new video. The videos are about 20 minutes long. They contain about 40 or 50 charts that can be downloaded. And if your listeners and viewers would like to check it out, they can find it at richardduncaneconomics.com. That's my website, richardduncaneconomics.com. And if they would like to subscribe to Macro Watch, if they hit the subscribe button, they can input the coupon code formula and get a 50% discount price off the subscription. And I think they will find that very affordable. And then they will have immediate access to 100 hours of videos in the Macro Watch archives. Plus they'll get a new video every 2 weeks for the next year.
Yeah, I highly recommend.
I hope they'll go there to the website and check that out.
Yeah, check it out. Highly recommend you do so. Richard also has a bunch of videos generally on how the economy works, which I think for a lot of people is who are professionals but not maybe in the economic field, very useful information to have, just to have a sort of a functional walking everyday knowledge of what's going on in the economy.
It doesn't work the way that it used to.
Yeah, right.
The economy, that's the big theme of Macro Watch. Our economy has evolved from capitalism into creditism. Instead of being driven by investment and savings as it was in the past, after dollars ceased to be backed by gold, credit became the most powerful driver of economic growth. So our economic system is now driven by credit creation and consumption. It works in a very different way than it did when money was backed by gold. And that's why so many people are confused about, what's going on with the economy, because it just doesn't work the way that they were taught that it does back in college. Things changed in the late 5 decades ago when dollars ceased to be backed by gold in very fundamental ways. And so that's the main theme that runs through Macro Watch, is that our economy doesn't work the way it does in the past. Our economic system has evolved from capitalism into creditism. And Macro Watch explains how the economy really does work today. And it explains the forces that really are driving the financial markets in the 21st century.
Thanks, Richard. And again, Wonderful to have you as usual, and probably talk to you in another 6 months.
Okay, let's do that. I look forward to it.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. And once again, if you have an interest in potentially participating in upcoming opportunities, make sure you go to wealthformula.com and join the Accredited Investor Club. You'll have to do a little bit of onboarding. That's about it. That's it for me. By the time this particular show goes, I will know who the Minnesota Vikings have drafted as their number one pick, and I'm hoping it is a quarterback, either J.J. McCarthy, Drake May, or Jaden Daniels. Let's just keep our fingers crossed. That's it for me this week. Talk to you soon. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.